Now audible? Now audible? Okay. So, very good afternoon. Welcome back again in the FSR report discussion, right? So far we have discussed a lot of things. I hope you are catching up with all these concepts which I have been discussing with you, as well as the facts. So in the last class, if you remember, we were discussing basically the government finance section, and in government finances we have discussed the gross tax collections that they have been increasing in double digits, and the most important contributor is the direct tax. Then we have also discussed the expenditure side, that government is continuously increasing its capital expenditure, which is a good indicator, right? And we have seen that gross fiscal deficit has been lower to what was the budgeted estimate for this, right? So we have seen these things. It shows that government is on a path of fiscal consolidation, isn't it? Right? So now remaining part we will discuss. First heading which you have is government debt. Mic में disturbance है? अभी better है? Is it better now? Okay. Right. So discussing about the government's fiscal performance, let's continue the discussion. So government debt, if we talk about, so as we have seen that the gross fiscal deficit has also declined. So effectively, if you see the government debt, so GFD, the gross fiscal deficit, it is pegged at 5.1% of GDP in 24-25, which is 46 basis points lower than in 23-24. So it shows that government's fiscal deficit is on a declining trend. Now, when fiscal deficit declines, we can say that government is on a path of fiscal consolidation. What is fiscal consolidation? I have discussed with you number of times. So when government tries to reduce the fiscal deficit and diversify its sources of revenue, right? So I hope by now you are very much clear with these concepts. We have been repeatedly discussing that. Now next point says that ongoing improvement in the quality of fiscal adjustment. Quality of fiscal adjustment is also reflected in the declining revenue expenditure to capital outlay or capital outlay ratio. So what is this revenue expenditure to capital outlay ratio? This is another important terminology which I want you to write down. Okay, so basically the report says that government's fiscal adjustment quality is improving. Government is performing well on its fiscal front. What is the indicator for that? On what basis we are saying? So we have seen that gross fiscal deficit is declining. Another important indicator which is there, which reflects this fiscal consolidation and improvement in the government's fiscal performance, is basically your revenue expenditure to capital outlay ratio. What is this? Write it down. So revenue expenditure to total capital outlay ratio. So your basic formula for this would be revenue expenditure divided by total capital outlay into 100. Now what is this ratio telling you? So basically it is a relative allocation. So basically it indicates relative allocation of what? Relative allocation of expenditure or funds by Government of India between consumption expenditure or revenue expenditure and capital. So between them, so it is an indicator which tells you in relation to consumption expenditure or capital expenditure, what is the government allocating. So basically a relative allocation. Is government allocating more to revenue expenditures or government is allocating more to capital expenditure? Are you getting my point, right? So have you understood this concept? Now if it is narrowing, it shows that more of the government funds are being allocated to capital outlay, to capital expenditure. Now you know very well, revenue expenditures of the government are basically, met, they meet the consumption requirements, the salaries which they pay, all these things. So it is not creating any asset against it, no capital asset against it. So that's why it is not very productive. But when you spend more in capital assets, it creates infrastructure. It creates assets which then make you earn in future, right? So narrowing down of revenue expenditure to capital outlay ratio is an indication that relatively more in relation to consumption expenditure, relatively more funds are being utilized for capital assets, or they are being allocated to capital assets. Understood, everyone? Tell me. Is this concept clear to you? Now you understand why revenue expenditure to capital outlay ratio is an indicator of government's improving fiscal performance, right? Okay. So now moving back to the discussion, I hope you have noted it down. Moving back to the discussion. So you see declining revenue expenditure to capital outlay ratio, which means the government is allocating more funds to the capital one, which is a good sign. Now next thing, alongside the share of borrowings directed towards growth inducing capital outlay has increased. Further important thing is that share of borrowings directed towards growth inducing capital outlay has increased from earlier 47.6 in 23-24 to 55.7 in 24-25. So basically government borrows to meet its expenditure requirements, right? But out of that borrowing, how much are you using for capital expenditures and how much are you using for revenue expenditures is an indicator which we cannot ignore, right? So just a common understanding, tell me one thing, if you borrow for meeting your consumption, your ability to pay back will be lesser in that case or higher. If you borrow, say for a capital, for investment purposes, tell me, if you borrow for consumption purpose, if you borrow for investment purpose, in which of the borrowing the chances of defaults are higher? Tell me. The chances of default is higher in which of the borrowing? Consumption one or capital one? Consumption one? Very good, right? Because then when you consume, you are not creating anything which can act as a collateral, right? So when you are investing, when you are borrowing, yes, more funds of, very good, everyone is correct. So when more funds out of your borrowing are going into capital assets, you have assets. You can use them to pay back your debt, isn't it? So similar thing, whatever applies on an individual applies on the government as well. Similarly, government's borrowing, share of borrowing going towards capital is increasing. That means government's chances of paying back that public debt will increase. So it will reduce the risk associated with the public debt. I hope you have understood now, right? So this trend is a good indicator then. Next thing is, consequently, the central government's debt is projected to fall. Also, the debt in total is also projected to fall. It is projected to decline. Now, you can also correlate this thing with the with the falling gross fiscal deficit, because as we have seen the formula, fiscal deficit is what? Total expenditure minus total receipts other than borrowing. So it is nothing but borrowing. So if fiscal deficit is declining, that means government has to borrow less. Simple, commonsensical, right? So we can draw parallels between declining fiscal deficit as well as government's lesser requirement of public debt. So that's why central government's debt, you remember this trend, it is projected as per the report that it will fall to 57.1 of GDP from earlier 58.4, which was the year ago, right? 23-24. In 23-24, it was 58.4. Further consolidating public finances. So it would be a further step in consolidation of government finances, right? I hope you have understood this. So we have discussed the government's debt situation. You have understood all these concepts and trends, right? Now we will discuss about states' finances, not individually of each and every state, but all these states which are there in India collectively. What is the performance of their finances, right? So state finances, if we talk about, so states combined gross fiscal deficit to gross state domestic product ratio for 24-25 is budgeted at 3%, which is unchanged from the level in 23-24. So basically, the next point says states debt to GDP ratio declined to 27.6% by 2024, from the pandemic high of 31.0% of GDP in 2021. Basically, what is this fact is saying? That first of all, try to understand this first point, okay? States combined GFD to GSDP ratio. GFD to GSDP ratio. What is this saying? Gross fiscal deficit. So what is this concept? I hope you are able to understand. So gross fiscal deficit to gross state domestic product, okay, GSDP. So you have GDP at the national level, and at the state level, how do we measure it? So at the state level, we have these state domestic product, right? So gross state domestic product. Now the report is saying that this thing, gross fiscal deficit to gross state domestic product, whatever fiscal deficit of the states are, okay, state are, and their state domestic product. So states combined GFT to the combined domestic products of all states, it has kept unchanged. So it has not increased, which is a good sign, okay, not increased, but not fallen down as well. So a status quo is maintained here, okay. So talking about the state finances, they are able to manage it. So it is 3%, which is unchanged. Any doubts from here? Is it clear to everyone? Understood? So what do we mean by GFD to GSDP ratio, right? It is combined. So we have combined all the gross fiscal deficits of all these states, then GDP of all these states combined, it has remained same, right? Okay. Next thing, alongside states debt to GDP ratio. Now what is debt to GDP ratio? Debt to GDP ratio is essentially an indicator. We have discussed this in previous analysis as well. Particularly, it is indicative of how much your debt is in alignment with the GDP growth. Basically, the present economic growth rate which you have, given that growth rate, are you able to pay back your debt, right? So debt to GDP ratio basically indicates how much share of your growth or debt is how much share of your GDP growth. So this indicator, it has declined to 27.6% by March 2024 from pandemic high of 31% of GDP in March 2021. So debt to GDP ratio, if it has declined, is a good indicator or bad indicator? Tell me. Debt to GDP ratio, if we say that it has declined from the previous levels, is a good indicator or a bad one? Is a good indicator or a bad one? Anyone? Okay, I'll be waiting for your answers. You tell me, since we have discussed this concept lot number of times, right? Yes. So, okay, I want all of you to answer this question, okay? Debt to GDP ratio declining for states is a good indicator or a bad one? If yes, why? If no, why? You have to tell me this thing, right? So far we have discussed the state finances. We have seen that GFD to GSDP ratio has remained stable, while states, that to GDP ratio, it is about the states, right? Combine all states, it has declined from the previous levels. So this was something about the finance side of the government of India as well as of the states. I hope you have understood all these concepts. Remember that concept, revenue expenditure to capital outlay ratio, right? These are certain important concepts here. I am explaining you each and every concept which is there, but you have to remember them, right? I can ask you in between as well. So tell me whether this is a good indicator or not. I'll be waiting for your answer, right? Now, next section which comes here is your household finance. Household finance. So far, any questions? Any questions so far? Shall I proceed further? So household finance, if you talk about, it is another segment which we need to look into. So interesting facts about household finance. So we have seen government finance, but what about the savings? What about the credit? What about the deposit? All these ratios related to household level, right? Because you know household savings are very important contributor in the investments of the for the overall nation, right? We all know that. So household savings, if we talk about, first thing which is there, the report says India's gross savings rate stood at 29.7% of gross national disposable income, with households being the primary savers and forming 60.9% of aggregate savings. Now this is a good indicator. This is a good indicator. Why? So see, report is saying that India's gross saving rate. What is gross saving rate? Out of, at 29% of gross national disposable income. So whatever national disposable income you have, what is disposable income? Okay, Guldeen, I'll come back to this point. Let's discuss the remaining part first, okay? I think the screen is not visible now. There is a power cut. Let me fix it. Stay tuned. I'm fixing it. Okay. So there is a power cut. That's why it is not visible. Just wait for a few minutes. Is it visible now? Now visible? Okay. All right. So let's discuss it further. So, India's gross saving rates they stood at 29.7% of gross national disposable income. What is disposable income? We have discussed number of times. Disposable income, the idea and the concept of disposable income basically means how much income you are remained with or you are left with, which is there with at your disposal. You can use it. So no liability is remaining out of it. So basically, if you see at the personal level, how do we calculate the disposable income? Yes, very good. So whatever income you have minus all your tax liabilities or interest payments accruing to any financial asset, all these things, right? So whatever tax liabilities are there, you deduct it out of your income, then you get the personal disposable income. At the national level, you have your national income, gross national income. So gross, when I say, so you should remember that when we say gross, so depreciation is included. And when we say net, in national income, depreciation is deducted out of it, right? So gross national income at the national level, whatever national income is there, so whatever is coming, you have earned from domestic sources as well as from the abroad, right? Minus all your tax liability, interest payment liabilities. Have you understood that? So at the national level, it would be national income minus your tax liabilities. At the national level, we are talking about. Understood, everyone? Right? So out of that, 29.7% stands to be your gross saving rate. It means you are saving more, right? Okay, with households being the primary savers. Now, one important thing is, out of this total saving in the economy, right, gross saving rate 29.7% out of gross national disposable income, the primary savers in this thing, primary contributors in this saving are your households. So households being the primary savers, they have formed 60.9% of aggregate savings. So 60.9% of your aggregate savings. Now what are aggregate savings? These are your 10-year average. While aggregate saving refers to your 10-year average for 2013 to 22, at 63.7%. So what do we mean by aggregate saving? By aggregate saving, we mean the 10-year average of it, right? So if you see the aggregate saving data, it shows that the 10-year average of aggregate saving has stood at 63.7, and the households are the major contributor to this gross saving rate. That shows that household savings are improving in case of India. Have you understood that? Is it a good indicator or bad? Tell me. I hope you will be able to tell this. Is it a good indicator or a bad one? Tell me this thing. Good indicator? Of course. So this thing I have discussed with you number of times that, when gross savings are increased in the economy, so savings are basically then channeled into investments, isn't it? So if we see that the gross savings as a percentage of, say, around 29% as a percentage of gross national income, they have been increasing, and that too savings by household. So that means your savings are getting channelized into the banking system, and then they are becoming, so you have funds for investment, because household savings are required for investments to rise, isn't it? Whatever you deposit in the banking system or the financial system gets translated into investments only, isn't it? So this is a good indicator. You all know that. You should be very sure about it. Okay. Then for household sector, saving in physical assets has been the dominant one. But remember, so there is a composition of this saving. We have seen that households have been the major contributor in this rising saving or gross savings rate. But there is a peculiar trend which you should remember. What is the trend? The trend says that for the household sector, the saving has been more into physical assets rather than your financial assets. Remember this thing. For households, the savings has been more into physical assets, has been the dominant and the rising component. Remember this trend. The saving has been more into physical assets. Okay. The share of net financial savings in the total household saving has been declining. It stood at 28.5 in 2022-23 from an average of 39.8 during the same period of 2013 to 22. Now tell me, is it a good indicator or not? So, rising household saving, only saying that households have been the major contributors in gross savings is not sufficient. You have to look into what are the components that the households are investing into. So what is the composition of this saving? So remember, it is more into physical assets. Physical assets like it can be your gold, it can be your physical properties like real estate, related properties, right? Anything else. So these kind of physical assets, they have attracted more of savings as compared to the financial savings. Rather, if you see the trend of the financial savings, so the share of net financial savings to household savings. So total household savings are there. Out of that, what are the savings devoted to financial assets has declined. So if share of, yes, very good, Gurleet. So, if share of net financial savings to total savings is declining, that means what are financial savings? So, physical assets, I have told you, physical savings, I have told you, in the properties, in the gold, etc. But when we talk about the financial savings, so it is going towards, financial assets. That can be your bank deposits, that can be your interest bearing assets, debt raising instruments, all these things. So, if it is declining, that shows that deposits into bank are declining. Also, if you could draw parallels in between this point and the other one, we have seen in this report only in the initial classes that the credit growth is outpacing. The credit growth is more than the deposit growth. Yes or no? You remember that fact? So this report only has highlighted that the credit growth is more than the deposit growth. Now this is reflective of this trend as well, that there is a decline in the net financial saving out of the total household saving. Yes or no? Are you able to recall that point? We have discussed in the FSR report class only. Right? We have discussed that too. Okay? So that's how you remember this thing. Now, combined with the rise in the financial liabilities, net financial savings also declined to 5.3% of GDP during 2022-23 from an average of 8.0. So, if you see the total or net financial savings, they have declined. Okay, net financial savings, they have declined. Here we have talked about the net financial savings of the households particularly. Now, as a share of total household saving, but if you see the overall net financial savings in comparison to their previous levels, so they have also declined. So this is the trend. Now, I hope you will be able to remember all these things. So gross savings rate has increased, okay? Has increased, or it has stood around 29%. Remember this thing, out of this gross savings rate, households are the major contributor, but we cannot be very cheerful about that, because this total contribution by households has something, a stark composition. What is the composition we need to look into? The composition says that these savings are more into physical assets, so they are not translating into investments for the economy, okay, as compared to the financial assets. So if financial savings are more, then we can say they will be able, we will be able to channelize those savings into investment. Also, we have seen that the net financial saving as a percentage of total household saving, it has declined. Also, the net financial savings in comparison to its own previous level has also declined, say to 5.3% from the earlier 8%. I hope you all are clear with all these household finance trends which we have seen so far. Is there any doubt regarding that, or is it clear to all of you? You have understood them, right? Understood, everyone? All clear? Okay, very good. So we have seen this thing. Now, further digging more into these trends, this report says that emerging trends across household financial savings, so particularly household financial savings we are talking about, right? So now we have subsections of this section of household finances. So what does the report say regarding household financial savings, particularly not the physical one? A sharp rise in household financial savings during the pandemic has been drawn down subsequently, as in many other economies, and shifted towards physical assets. This is something which we have recently discussed, that households are saving more into physical assets as compared to the financial assets. But it was higher, during the pandemic. But after pandemic, why this decline? So can you tell me, there must be a behavioral factor to it, isn't it? There must be a behavioral reason to it, a psychological reason to it, that after the pandemic, the households have felt a need of, saving their money, saving their funds into less riskier options, isn't it? So having savings into less riskier options must have been the behavior of the households. That's why you see, after pandemic, this contribution into physical assets as compared to the financial assets out of total household saving has increased. Yes or no? Do you agree with me? So there is a behavioral factor attached to it. There's this risk perception. There's this shock which we have dealt with during the pandemic that has amounted to this kind of behavior by households, right? Okay, so I hope this is clear to you all, right? Also, that the report says that alongside, households are also diversifying their financial savings. They are allocating more to non-bank and capital markets. So now, due to the risk involved in the pandemic which we have seen, so households are basically now finding avenues. So they are searching for alternatives in which they can invest their savings. So alongside households, alongside this thing, households are also diversifying their financial savings. They are allocating more to non-bank and capital markets. Simply. Is this clear? Right. So I hope this is clear to you all. Households are also searching for new alternatives. That's why you see they are investing in non-bank or capital markets. That's why you see there is rise in the physical assets or household savings going into physical assets as compared to the financial assets. Okay. Then at 40.1% of GDP, the stock of household debt in India is relatively low when compared to other EMEs, but in relation to GDP per capita, it is comparatively higher. Now we have seen the condition of public debt in case of India, right? We have seen the situation of public debt for India. So public debt has been rising at the global level as well. We have seen that. In India, you see, although we are gradually narrowing it down, but then again it is higher, right? So in that case, now we are comparing it with the household debt. So stock of household debt in India is at 40.1% of the GDP. It seems to be relatively lower when we compare it to other emerging market economies. Physical assets are rising. We have seen this thing in the previous analysis of this when the class started, right? The physical assets savings are rising they are more in comparison to savings directed towards the financial assets. Clear? Okay, as we have seen in the previous. Clear? Okay. Now, so one more trend which you need to focus upon here is saying that stock of household debt in India, if you see, is at 40.1%. If you compare it at the international level, the visuals have gone, right? Again, it's a power cut. So I don't know why is it happening again and again today. I'm just trying to start it again. Okay. Is it visible to you? All right. Now, okay. So you see stock of household debt in India, if compared to emerging market economies. So emerging market economies के comparison में it would seem to be lower because they have a higher household debt. So debt owned by all the households in your economy. Are you getting my point? But in relation to GDP per capita, if you compare this debt to your GDP per person, GDP per capita is GDP per person. So in relation to GDP per person, it is comparatively higher. So household debt, in comparison to GDP per capita is higher, but if you do the international comparisons, it would seem to be lower because other emerging market economies, they have a higher household debt. Is it clear to everyone? Now, as per the new schedule, after the launch of the offline batch, our Monday is off, Tuesday is a working day. Okay, so now we have classes on Tuesday, we don't have classes on Monday. This is clear, right? So remember this trend as well, this is important, that stock of household debt in comparison to EME is low, but if you compare it as a percentage of GDP per capita, it is high, which is not a good sign. That's why you see, we are coming to it, retail inflation in India is continuously growing and RBI is trying to manage that, is trying to contain that, because retail inflation, retail lending, not retail inflation, sorry if I use retail inflation. So retail lending is increasing. Why? More risk is attached to it as compared to wholesale lending. Because in retail one, these components, there are variety of loans being offered at the retail level, at the individual, which is also known as direct lending or consumer lending, right? So in this case, you have several loans provided without collateral, like, loans for emergency needs, medical emergencies, loans for your, say, personal loans, right? So for marriage, etc., for travel bookings, vacations, all these, right? Yes, more people involved, plus less of, so there is without collateral loans also being provided. So now RBI is keeping watch on these type of loans. It will come into this report further. Okay, we will discuss it then. So you see the overall household saving declining to 18.4% of GDP in 22-23 from average of 20% of GDP over 2013 to 2022 period. And coupled with an increasing trend in financial liabilities, household debt warrants close monitoring from the financial stability perspective. Now you see, we have seen a trend regarding household debt, right? Finally, what we can say is, that overall household savings, they have declined, right? So that's why you can now draw parallels with what we have discussed earlier, credit rate being increasing more in India in comparison to deposit rates, isn't it? Why? Because household savings are declining. As percentage of GDP, if you compare it from the previous levels, so for 22-23, it was 18.4% of GDP, which is lower from what we have had in the period in between 2013 to 2022, was around 20% of GDP. So if household savings are declining, and that too, along with that, it is coupled with these kind of indicators, increasing trend in financial liabilities. Their financial liabilities are increasing. So household debt warrants close monitoring. That's why I said retail inflation, retail loans, particularly the direct lending, the consumer lending, basically. So it needs a close monitoring on the part of the regulator to ensure financial stability. Why? Because if your liabilities are increasing and then your savings are falling, there can be a risk, there can be a default. So there are high chances of defaults to be there on the side of households, which can then translate into a systemic risk at a bigger level if it goes unchecked. Do you agree with that? Right? So this is the overall health of the household finances. What can you say regarding household finances now, since we have discussed it? Is it in a bad shape or a good shape, or is it in between or if we keep on monitoring it, then we can protect it from going into a bad shape? Tell me, what is your opinion? Okay, so you are saying it is going towards bad shape. What about the others? Okay, you are saying it is in between right now, right? So yes, so basically if you talk about the household finances health, we are seeing there is a divergence going on between what we have witnessed from 2013 to 22 levels. Pandemic has to contribute to it, right? Pandemic, the fear of the pandemic, which it has inserted into minds of people, has to do with it, right? It has changed the people's behavior and perception of savings, right? We can say that also. So this analysis would be not be sufficient. You have to conclude with this thing that household savings are reducing. Also the savings, if you see, they are more into physical assets as compared to financial assets, but their financial liabilities are increasing. So we need to monitor them in order to prevent the household finances going into a bad shape. So still we have that hold, we can prevent them into translating into more NPAs, right? So that responsibility lies with your banking sector regulator. Is this clear to everyone? Right? I hope you have understood this thing, right? No doubt so far. Okay. Now, if you see the mutual funds, what is the situation of the mutual funds? Broadly, what the report says regarding the mutual funds. So, bolstered, so it is saying bolstered by the increasing participation of households, the asset under management of the mutual funds has grew up. So this industry, is performing well. This industry is performing well. More people are participating in mutual funds, more people are participating in SIPs, systematic investment plans. This has resulted into AUM. Write this concept, asset under management. I think I have discussed this concept with you earlier as well. Asset under management. Asset under management basically is a terminology which indicates what is the total market value of all your investments being managed by the asset management company or the mutual funds. So it includes all your stocks, bonds, securities, whatever you have invested on the behalf of your clients, right? So whatever you have invested on the behalf of your clients, all those investments which you are managing right now, with the securities, the instruments which you hold right now, what is the total market value of them, right? So if AUM is higher, it means your investment portfolio is bigger, you have more to earn, right? You have more market presence. All these indicators are there. Higher AUM is also reflective of your higher credibility, right? Understood? I think so. If I'm right, I have discussed this concept in RBI annual report as well with you. In RBI annual report as well, right? So you remember what is AUM. So now we are saying that that bolstered by increasing participation from households, the assets under management, they have grew by 35.5 during this financial year 23-24. So households, they are showing more confidence into mutual funds. That's why you see, now you can draw parallels between households' savings or investment behavior, right? In the household finances, we have seen households they are basically finding alternatives to deposits with the banks. Yes or no? Quickly tell me that they are searching for alternatives. So where they are going? Into physical assets plus mutual fund or SIPs. So everything is interconnected, right? Diversifying, yes. So you connect all these dots. These are not operating in isolation, okay? Also, if you remember one of the editorials, we have discussed particularly on SIPs. In one of our editorial classes, we have discussed that Indian middle class is falling in love with SIPs. This was the statement I clearly remember from the class which I have told you, right? So particularly middle class of India, yes, particularly middle class of India, it is investing more into SIPs, right? So the investment made through SIPs, they form 19.6% of total AUM of the domestic mutual fund industry. Of the total AUM, the investment through SIP only is 19.6%. That shows that people are systematic investment plan which you have, so SIPs are basically which provides you regular, smaller or regular contributions, right? So you can go with less risky, smaller amount of contributions at a regular interval. We have discussed this thing in the editorial classes as well, particularly in middle class, because they don't have too much to invest. Also, since we are middle class, right, we struggle to manage our funds. Our lives just are revolving around EMIs. Agree or not? So middle class is very actively equated with the EMI, right? So given that situation, limitation of finances, and then we cannot afford much risk. So that's why you see middle class going more into SIPs nowadays, right? So this is the thing regarding mutual funds. I hope you have understood this thing as well. So mutual funds in India, overall story, if we talk about, are performing well, AUM, their AUM has been good, and the major contributor in AUM is SIP. Remember this thing. So Indian middle class basically is showing confidence into AUM or also SIP of these mutual funds, right? SIP is being offered by these institutions. Any doubt so far? I hope you have understood all these things. Government finances, household finances. महीने की शुरुआत की खुशी EMI ले जाती है. Yes, so middle class, this story is very common to all of us, whatever we earn, we are just struggling to manage out of it. We have to pay a lot of bills, a lot of EMIs, and nothing remains out of it, right? We are able to save anything. So I hope I'm trying to make this report, as relatable. It is a very technical report. I'm continuously trying to make it more relatable with practical examples so that you can remember all these things. Also, I hope you are not concerned with the number of classes which this report will take, because the thorough coverage is what we should focus upon, right? So I'm not in a hurry of completing this report in 1 or 2 classes. I just want to convey whatever is there to you in the best possible manner. That is my concern. Okay. So I hope you don't have any issues with the number of classes. It is of no use even if you cover this in the entire report in 1 hour only, and then you get nothing out of it, right? Okay. All right. Also, since I'm not feeling well, so I'll not be able to speak further. Also, it's time, so I think I'll continue in the next class. Okay. It is not walkie-talkie, it is the mic. Okay. It is the mic, right? Yeah. So I'll be able to continue in the next class only. I hope there are no questions. I hope you have enjoyed the report. You are understanding all these concepts. Have a very good day. I'll see you in the next class. We will resume from here, the banking system. Okay. Yeah. So we will resume from here, banking system, in the next class. All right. Thank you so much. I'll see you all in the next class.